The backdoor Roth might be the greatest tax loophole for high-income individuals, but 99% of people have no idea how to do it correctly. So in this video, I'm going to show you exactly how to do a backdoor Roth contribution, the 2 common mistakes that you should avoid, and I'll share a few extra tips and pointers to help make sure you do this correctly. Hi, my name is Jacob Duke, and I'm the owner of a retirement planning firm where we help people just like you plan smarter so you can live better in retirement. Now, if we're going to talk about how a backdoor Roth IRA contribution works, we need to first understand what it is and why it's even necessary. So, what is it? It's really just a roundabout way to make a contribution to a Roth IRA, and it's a multi step process instead of just making a contribution directly to a Roth. So, that's the simplest answer, but why is it necessary? Well, there are income restrictions around who can contribute directly to a Roth IRA, and you can see that here in 2025, the income limit for single filers is $165,000 and it's $246,000 for married filing jointly. Now, that's the top of the phase out range. So there's actually a lower number there. You can see $150,000 and $236,000. That's where the phase out range begins for this Roth eligibility. So if you earn less than $150,000 as a single tax filer or under 236 combined married filing jointly, you are free and clear to make contributions directly to a Roth IRA. As soon as you go over those numbers, you enter the phase out range, which means that you won't be able to make a full maximum contribution to your Roth IRA in that tax year. You would be able to make a partial contribution up until that top of the phase out range, at which point you cannot make a contribution directly to a Roth IRA. So that's where the backdoor Roth comes into play. And what most people don't understand are 2 mistakes. I'm going to share those with you along the way. And if you want a copy of this PDF, this important numbers data sheet that I often refer to in my videos, you can just shoot me an email. I'll happily send it over to you. It's a free PDF, so you can use it as you need to in your retirement planning. Okay, let's walk through how a backdoor Roth IRA works, the steps it takes. I'm going to tell you about all the tax forms that you need to know about and that you will get if you go through this process, as well as a few extra tips and pointers at the end. So let's go ahead and get started. So the first step here on a backdoor Roth IRA is we have to have a traditional IRA open and a Roth IRA open. So we have to have both accounts open. And when we're ready to make a contribution to our Roth, instead of doing it directly into the Roth IRA, what we're going to do is we're going to make that contribution first. We're going to do that first to the traditional IRA. So we're making our contribution to the traditional IRA and not the Roth. So that's the first step. The second step is to then convert that money that you just added to your traditional IRA. Let's say that you're over age 50, so you would have the catch up. So instead of $7,000 being under 50, you would have $8,000. So let's assume that you're trying to make an $8,000 contribution. You put that $8,000 in the traditional IRA first. You would then convert that $8,000 to your Roth IRA. So at this point, the money is in your Roth. You've put money into the IRA first, you've converted that to the Roth, and now it's all there. One of the more common mistakes, this is not one of the 2 that I'm going to share with you, but this is a common mistake that I see, is people don't invest that money immediately once it's in the Roth. It sits there in cash, not earning anything for a little bit of time. So go ahead, and once that money is in the Roth, make sure it's invested how you want to have that invested. And don't forget that important step. Now, the third step here is one of the most common mistakes and something that could be a huge issue if you don't do this correctly. So here's what you have to do next. Once you've done all this, whenever it comes tax time, after the year is ended and you're filing your tax return, you need to file Form 8606, okay? This is something that most people don't know to do, so they don't do it. But Form 8606, what that does is that tells the IRS about any non-deductible contributions that you have made to your traditional IRA. And the question is, well, Jacob, I thought my traditional IRA was a deductible account, meaning I put that money in, I take a tax deduction on my return, and I don't pay taxes on the money I put in. Well, can I even make a non-deductible contribution to that account? And the answer is absolutely you can, because again, referring back to the important numbers data sheet, you can see that there are IRA deductibility limits based on your income. So you can't always make an IRA contribution and have that deductible 100% of the time, especially if you have an employer plan that you are able to be involved with. So if you have a 401k or a 403b or TSP, you have lower income limits to be able to deduct an IRA contribution out. And you can see that here. So if you're single, the phase out range is $79,000 to $89,000. If you're married filing jointly, it's $126,000 up to $146,000. And then that final line there that says married filing jointly, and then in parentheses it has if only the spouse is covered. That means that if your spouse works and they're covered by a 401k or an employer retirement plan, but let's say that you either work and don't have one available to you, or you don't work and obviously you wouldn't have an employer plan at that point, you can then make a deductible contribution up to those income limits, being 236, instead of being able to have unlimited income and deduct. So if your spouse is someone covered by an employer plan, you still have income limits to be able to make a deductible contribution to an IRA. So just know that whenever you're thinking about this, you can make a non-deductible contribution. And in fact, if some people do make contributions, that would be forced to be non-deductible because of their income being too high and them also being covered by an employer plan. If you and your spouse, neither of you are covered by an employer plan, meaning you don't have a 401k for either of you, there's no deductibility income limits for IRAs. Anyone can do that at any income level. So that's a little sidebar, and that's how a non-deductible contribution to an IRA works. And that's why you have to file Form 8606 with the IRS. And so what you're going to do here is you're going to file the form. So it's going to be a non-deductible amount of money that went into the IRA, so that whenever you go and pay, convert that money to your Roth, you're technically not going to pay tax on it because it's not taxable money. It was taxed on the front end, meaning it was non-deductible. So Form 8606, what that does is it helps the IRS know what basis you have in your IRA. And I'm going to get to another one of the mistakes here in just a second and why this is so important to know. But that's the three-step process. You got to have your IRAs open, traditional and Roth. You have to contribute the money to the traditional IRA first. You have to convert it to the Roth IRA second, make sure it's invested once it gets there. And then you have to file Form 8606 with your tax return once you start doing your taxes for that particular tax year. So those are the steps, and that's one of the big mistakes. Now, what kind of tax form should you expect to get as you go through this process? The first thing you should know is whenever you make any sort of contribution to an IRA or a Roth IRA, you're always going to get what's called a Form 5498. Now, this is just an informational tax form. There's nothing for you to do. You don't file anything on your taxes with this. What this does is it simply tells you what contributions you made to your IRAs in the previous tax year. So this form typically gets mailed to you or dropped electronically into your vault around May-ish of the following tax year. So after the tax filing deadline, so May is whenever that would typically come in. And you can see what that looks like. Here's a quick little screenshot of what this Form 5498 might look like as you get one. It's just a little piece of it. And this one's from 2023. But you can see what it says here. For IRA contributions, you can see how much you contributed. And why this is so important is because if you've made contributions to your Roth IRA and you are not 59 and a half and you have not had the account open for 5 years and you want to take money out of that Roth IRA, you can always take out your contributions tax and penalty free. But the hard part is you got to know what your contributions actually have been. So that's why you need to hold on to all of your 5498s as you get them, because you will not know what you can take from your Roth IRA without tax or penalty. And if you don't have these on file or keep records of this and you get audited and you have taken money out of your Roth IRA without being able to offset that with a 5498 for your Roth, the IRS could say, hey, we don't have any proof here that this was an eligible distribution without tax or penalty, so therefore you could be paying something there. So it's important to hold on to your Form 5498. So here's what's going to happen. Whenever you make that contribution to your traditional IRA for the first step in the Backdoor Roth process, you're going to get a 5498 for that tax year for the contribution you made to your traditional IRA. So this one, we're going to go through a couple here. This is for your traditional IRA. So traditional IRA is what this one is showing us. And you can see that here, and I'm going to show you the difference here in a second. But IRA contributions, $6,500. This is for 2023, which that was a limit back then. So you're going to get $154.98 for your traditional IRA. Now, the next tax form that you're going to get upon converting that $6,500 over to your Roth IRA is a 1099. That 1099 is going to be associated with your traditional IRA because that's where the money has left and now it is going into a Roth. And so you will get a 1099. But the key is, again, because this was a non-deductible contribution, which if you're filing Form 8606, the tax forms and the IRS will know that correctly. This taxable amount, that's what it's showing here on the 1099. Technically, that's not taxable if you file Form 8606. So that's why this is so important to file. And you can also see a couple extra things here. You can see a little interest maybe earned in the account before it was converted. So one tip for you on this is convert the amount of money immediately to your Roth upon it being deposited into the IRA, because if you have any interest accumulate, technically that's going to be taxable to you. So the $1.35 in this example, technically that's taxable to them. The $6,500 would not be taxable. So if you let that sit there, let's say you put in a non-deductible contribution for your Backdoor Roth in January of 1 year and you don't convert it until December, well, you're going to have some interest on that over that full year, and you would be taxed on the interest amount and not the non-deductible contribution portion. So that's the second form. This is a 1099, and that's going to be associated with your traditional IRA. Now, the next form you're going to get is a 54.98. Okay, so the same thing as you get for the traditional IRA, you're getting one there. You're also going to get one on the Roth IRA side for the contribution that has now been made to your Roth IRA. So you get one for both accounts. This one here is most important, I would say, because you know that that's for your Roth. You can see that is how much went into it. Okay, and it'll also show you what your true fair market value of the account would be at the time. But this is the one that's important to keep, because again, if you ever want to take money out of that Roth IRA, you've got to have this on file to back up what you're doing in terms of the distributions you'd make that would be tax or penalty free. So that's the third form you're going to get. So you're going to get a 5498 for both accounts. You're going to get a 1099 from your IRA. And here is an example of what Form 8606 might look like. And you can see this is for non-deductible IRAs. So as you fill this out, you'll see a little bit of note here. What did you make? Well, it's a $6,500 non-deductible contribution. Do you have any other basis in your traditional IRAs at this point? The answer is no. So the total is still $6,500. And then one of the big items here is hopefully box 6 will be 0 or not filled in. And what this is telling us is that if you have something there, that means you have a balance in your IRA or your SEP IRA or your simple IRA. So you have money in a tax-deferred IRA, and that is not what we want. So this is the second major mistake that a lot of people make. It has to do with the pro rata rule. What it basically says is if you have any money in an account that's tax-deferred and then you add a non-deductible portion to that, which we're doing here with the Backdoor Roth, you don't get to, whenever you do a conversion, you don't get to pick which section of money or which part of the account you actually want to convert. So you don't get to say, I want to take the $6,500 in this example that we contributed to do the Backdoor Roth. I want to take that and convert it so that it's not taxable. You don't get to make that decision. What happens is as soon as you add the non-deductible portion into the other money that's already been contributed and is deductible, that blends together and you can't separate the two. And essentially that non-deductible portion becomes just a percentage of the overall account. So for example, let's say we had $6,500 in your account already that was a deductible contribution from previous years. Now you also add another $6,500 to the account to do a Backdoor Roth, and then you convert that $6,500 to your Roth IRA as we're going through the backdoor process. Well, what happens there is only half of your $6,500 is actually non-taxable. So the other half of that $6,500 you're converting is taxable because of the pro rata rule and the fact that 50% of your value of the account is non-deductible. The other 50% is tax deductible. And so again, you can't separate the two. So what's the solution here? What's the fix here to kind of solve this? The fix is don't have any money in a traditional or a SEP or a simple IRA whenever you're doing a Backdoor Roth contribution. Doesn't mean you can't do a Backdoor Roth, just know that you would be paying taxes to do the Backdoor Roth. Whereas previously, whenever you don't have any money in those accounts, you would not be paying any additional taxes to do a Backdoor Roth contribution. So that's the second big mistake, is many people just don't know about the pro rata rule or how it even works. Just be aware of that. But this is Form 8606. Again, just take a look at that. Maybe you have to pause and look at what this looks like, but that's how it works. That's what you need to fill out to make sure that your non-deductible contributions are factored into your taxes correctly. So what are some different tips or things that I would say to make this process easier or make it better for you? The first thing is do it one time. Don't add $500 a month to your traditional IRA over the course of the year and then convert it all at once, because again, you're going to have some interest and growth and things that have popped into the account that would be taxable, even though your original contribution amounts of the $500 a month would not be, since they would be non-deductible. Makes it a lot cleaner if you just do it one time, convert it at one time, rather than doing multiple contributions throughout the year. The second thing is avoid that pro rata rule issue. So how can you do this? Well, don't do a 401k rollover. That's one of the big mistakes as well. Don't do a 401k rollover in the same year in which you do a Backdoor Roth contribution. So the rule states on pro rata here that it's based on the amount of money in the account at the end of the calendar year in which you do a conversion. Okay, so even if you do a Backdoor Roth contribution on January 2nd to get your contribution done for the year, you can't do a rollover for the rest of the year, because then you have a balance in the account by the end of the calendar year. So it doesn't matter if you do it before you have a balance or after you have a balance. If there's a balance in the account in your traditional IRA at the end of the calendar year, pro rata rules might be an issue for you. So that's one tip, is if you do a Backdoor Roth contribution in any given year, make sure not to do a rollover that year later after you've done it, because you would run into pro rata issues at that point. Here's one big question that a lot of people have is, Jacob, I know I can make a contribution to an IRA up until the tax filing deadline of the following year, so April 15th. I have until then to make a contribution. How does that work with backdoor Roths? Can I still do a backdoor Roth contribution in up till April 15th or not? Is there anything weird that's going on there? And the answer is yes, you can, but there are a few differences. So it's just an accounting difference on the back end. So whenever you make a contribution to an IRA, after the year ends, but up until that April 15th deadline, you're going to get a 5498 for the corresponding year. So we're in 2025 right now. So if I want to make a 2024 IRA contribution, I can do that still. It's not April 15th yet. And I would get a 5498 for that contribution for the tax year 2024. Okay. So that's the first step. Now, that's the only thing that you're going to get for the tax year 2024. And if you want that to be a non-deductible contribution, you still need to file Form 8606 on your 2024 tax return. So that's step one. We put the money into the account. Now, whenever we do the conversion piece of this and move that money into the Roth, you're going to get a 1099, but that 1099 is not going to be for 2024. It's going to be for 2025 because all conversions within an IRA account happen within the tax year in which they happen. So you can't say, I want that to be for a 2024 Roth conversion. It's going to be a 1099 based on 2025's tax year at the time in which you do that conversion. Additionally, you're going to get a 5498 for the Roth portion of this equation, and you're going to get that 5498 again in the tax year of 2025 because that's when the money is actually going into the account. It's not going to be a 2024 contribution. So those are a few extra things to know. You can do a backdoor Roth contribution after the tax year has ended, but the accounting on the back end, some of the tax forms are going to be a little bit different than you might expect. So hopefully this video is helpful and gives you some insights around how to do a backdoor Roth contribution correctly. Let me know your thoughts. I'm curious if you have any follow-up questions or if there's anything that I can do to make this easier for you moving forward. Thanks so much, and we will talk to you again very soon.